India's gross domestic product grew at 7.6% in the September quarter of 2023-24, surprising experts and economists. But RBI Governor Shaktikanta Das had some inkling.
Looking at the momentum of economic activity, looking at a few early data points which have come in, a few early indicators, I can say that the second quarter GDP number, as and when it is released at the end of November, in all probability will surprise everyone on the upside.
Manufacturing and construction activities led the charge. Both expanded by double digits. The Q2 print indicated that economic recovery was well on track for 6.7% growth in FY24. The manufacturing and construction sectors clocked robust 9-quarter high growth. The strong manufacturing growth was driven by a surge in listed company profits. The construction sector benefited from the front-loading of capex by the centre and states. But growth in services slowed down. At just 5.8%, the slowdown in the services sector to a 6-quarter low was driven by the trade, hotels, transport and communication services subsector.
Well, I think the services had rebounded very strongly, so they are now correcting. I think if you look at even the PMI for services, that is slowly coming down. I think the data came out for November today. It shows a moderation over October also. So I think services are slowing, but at the same time, goods, which is manufacturing, is picking up. I think that's going to be a global trend. I think it's not specific to India. You can see that the air traffic or hotels, restaurants, I think in general, I think they had remained very strong. So over a high base, I think there'll be some softening that takes place, but it will be replaced by the manufacturing sector, as we saw in the data. And manufacturing PMI, by the way, went up in November compared to October.
In the same September quarter, the agriculture sector saw the slowest expansion in the past 18 quarters at just 1.2%. This is because growth was weighed down by a weak and erratic monsoon. It also suggests that rural demand is under stress, which has prevented consumption demand from being broad-based. This is also reflected in the subdued sales of FMCG products in rural areas.
The agriculture sector, first of all, has done very well since the pandemic struck. I think we've grown stronger at a much faster rate than the trend rate. Now, so the base is also quite large in agriculture. Now, the errant monsoons are playing out, but agriculture estimates are subject to change. And what we need to watch out for is what kind of growth we see in the allied sectors, the allied activities, animal husbandry, etc., which typically tend to offset. This year, for sure, we'll see slower than the trend rate of growth that we have seen in the last 3-4 years. How much, I think, is very hard to predict.
Another point that stood out is private consumption, which is taken as a proxy for household consumption. Growth in private final consumption expenditure, or private spending, slowed down to 3.1%. This was due to the continuing distress in rural demand. Private capex too remained weak.
On the consumption side and on the expenditure side aggregates in general, initial data gets revised a lot because there are data availability issues, and so I don't usually get terribly swayed by what is coming out of these aggregates. Having said that, I do believe that consumption is a story of urban versus rural. And going ahead, I do believe that rural demand is going to be quite cautious given how we're setting up for the agricultural outlook, and that's not looking very good right now.
So private investment hasn't become very broad-based, but I think it is showing signs of a pickup. The government will have to withdraw because they have fiscal concerns over the medium run. I think they have to reduce the debt to GDP ratio. They have a medium-term fiscal consolidation plan. So the baton will have to be picked up by the private sector. The focus now should shift towards pushing private investment via making the environment more friendlier, because corporates are in good health. I mean, the mid and the large size corporates have very good balance sheets, and they are in a position to invest at this juncture.
One of the less encouraging points that stood out among the Q2 numbers was that demand was primarily driven by the government, both in terms of consumption and investment. Government spending picked up and grew at 12.4% in real terms. indicating that both the centre and state governments expanded their public expenditure. Because of the front-loading of capex by the government, gross fixed capital formation, which represents investment demand in the economy, grew at a 5-quarter high of 11%.
So going forward, we expect the pace of growth of capex by the center and the states to slow down quite a lot in the second half as compared to the first half. In the second half of the year, we've had the assembly elections. Then we will have the model code of conduct coming in potentially sometime in the next quarter before we go into parliamentary elections. And with all of this, we do expect that the pace of capex is going to slow down. Now, in the month of October, we had a 15% contraction in Government of India's capex already. Around 5 trillion is left compared to the budget estimates to be completed in H2. So there is really a lot of headroom. We do expect that the budgeted targets will be missed both by the center and by the states.
Overall, the Q2 numbers left a positive impression on the experts. But there were some caveats.
To me, what was really surprising was the manufacturing and construction growth numbers. Those were the kind of numbers I expected for Q1, not for Q2. So I'm really curious to see whether we're going to end up seeing some rebalancing between these two quarters when the eventual revision comes through going forward. So perhaps growth will end up being revised higher for Q1 and slightly lower for Q2.
It's a very strong rate of growth, 7.6%. And by the way, I should also point out that in the third quarter, many other economies also outperformed. US grew at 5.2%. China also grew above 6%. So I think there are other countries also which grew, but I think India does stand out because it's a pretty large economy and it has sustained a pretty strong rate of growth. And this year, there is absolutely no doubt that India will be the fastest growing G20 country. So it's a very strong momentum. Not every sector is doing well, but I think overall there are bits of good news in this number.
While growth momentum has continued so far, challenges await the economy. Most economists say the growth rate will come down significantly in the second half of the year. The RBI's State of the Economy report has also said that the central bank is preparing for an anticipated uptick in inflation readings for November and December.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.
He's moving from employee to employer. Business Standard.